Good morning, everybody. As Bob said, I'm going to talk about income taxes. There's three main areas that I'm going to talk about. First, I'm going to talk about the current tax laws for this year, what we think may happen next year. I'm also going to talk about some tax planning, and the last topic is IRS alert, which are some areas that the IRS is scrutinizing and auditing at this point. Here's just a cartoon that I found on the internet. To me, it's the IRS always says that they're simplifying the tax forms, and this is what we seem to get. It's still a maze with the tax forms. So for this year, what we know for 2012, long-term capital gains rates are the same as they were last year. If you're in the 10 or 15% tax bracket, you will pay nothing on your capital gains. All other tax brackets, capital gains are taxed at 15%. Qualified dividends are also taxed at 15%. Typically, these are taxed at ordinary income rates. Some other things happening this year, the 2% payroll tax cut is extended through the end of this year. We're almost to the end of the year, but that will apply for the last couple months of the year also. The standard deduction amount is going to be $11,900 if you're filing a joint return, married filing joint, and $5,950 for single taxpayers or for those filing married filing separate returns. The exemption amount is $3,800 per taxpayer and all of their eligible dependents. This year, more taxpayers may be subject to the alternative minimum tax. The alternative minimum tax is a separate taxing scheme that computes income. It was intended to apply to a small number of high-income taxpayers, and there was an exemption amount that was enacted to protect middle and low-income taxpayers. The problem that we have this year is that when this was enacted, it was never permanently indexed for inflation. So every year or two, Congress enacts legislation to set this exemption amount so that low and middle income taxpayers aren't subject to the AMT. Congress has not done that for 2012. And if they don't do that, it means that the exemption amount goes from about $75,000 down to $45,000, and will subject most of us, probably all of us in this room, to having to pay alternative minimum tax. Hopefully they'll do that by the end of the year. They could also do that after the first of the year and make it retroactive before we file taxes, but that has yet to be done. Depreciation, which is always important, expense, Section 179 expense deduction this year is limited to $139,000. Last year it was $500,000, so that's quite a drop from 2011. This deduction is reduced for purchases that exceed $560,000. Last year that amount was $2 million, so that's gone down dramatically also. Section 179 expense deduction is valid for both new and used assets and applies to machinery, equipment, special use or single purpose agribusiness buildings like bins, drying system, livestock barns. However, it does not apply to general purpose ag buildings like machine sheds or shops. Bonus depreciation is still in effect for this year, although bonus depreciation is only 50% of the purchase price, whereas last year it was 100%. Bonus depreciation applies only to new assets with depreciable lives of 20 years or less. The rules for bonus are that you have to apply Section 179 first. Then if there's any basis left, you take the bonus, and then makers can be taken on any remaining basis. Wisconsin's depreciation, Section 179, and this is not a change, this is the same as it was last year. Section 179 expense deduction is limited to $25,000, and that deduction is reduced for purchases that exceed $200,000. Once again, Wisconsin has no bonus depreciation, and for the federal, if we take more depreciation than Wisconsin allows, or if we take bonus, we end up adding that back in on the Wisconsin return to calculate your Wisconsin taxable income. Some credits that are still around this year, as you can see, the dairy and livestock farm investment credit, farmland preservation credit, the dairy manufacturing facility investment credit, which is a credit that's usually passed on from the co-ops to those members, and the beginning farmer and farm asset owner credits are still available. So if you've had these in past years, you're probably still eligible. If you haven't, you may be eligible. If you have any questions on those, I can answer those at the end, or I can direct you to the Wisconsin Department of Revenue's website where you can find more information on all those credits. Next year, guess the bottom line is, we don't know. I think President Obama has alluded to the fact that if he's reelected, he intends to let the Bush-era tax cuts expire. With the expiration of the Bush tax cuts, this is what we see happening, what will happen. Qualified dividends that are now taxed at 15% will go back to ordinary income rates. So that's going to be a benefit that's lost. The bottom marginal tax rate is going to go from 10% to 15%. There will be no 10% tax bracket. The top marginal tax rate will go from 35% up to 39.6%. And then you can see my next bullet point here. This year, for 2012, we actually have 6 tax brackets. They're getting rid of the 10% if the Bush tax cuts expire, and there will be 5 brackets. And another thing about these brackets is the brackets are much more narrow moving forward than they are this year. So for instance, you could have about $74,000 of income this year and be in the 15% tax bracket. Next year, you will be in the 28% tax bracket if you have $57,650 of income, taxable income. So you're going to hit the next tax bracket at lower levels of income. So that's going to directly impact all of us. Middle income taxpayers and middle class taxpayers are going to get hit, as well as the high income taxpayers. Also, long-term capital gains rates are going to go up. The rates will be 10% and 20%. It hasn't been determined what tax brackets will pay what rate, but it's likely, or I think, or if you're in the 15% bracket, you're probably going to pay 10% on your capital gains, and all other tax brackets will likely pay 20%. But that is uncertain at this point. Some other changes, and the first 2 bullet points on here are not dependent on what happens with the Bush tax cuts, whether they're extended or they expire. The first 2 are part of the Affordable Care Act, or Obamacare. There's going to be a 3.8% Medicare tax that's imposed on net investment income of high-income individuals. And right now, high-income individuals are single taxpayers with incomes more than $200,000, or married taxpayers with a combined income of more than $250,000. So if you're in these income levels, you're going to pay that increased tax on investment income, and that does include rental income. So for some of our taxpayers, our clients who have rental income and their incomes are that, you're certainly going to end up paying this extra tax. Also, there's a 0.9% hospital insurance tax imposed on these same taxpayers, and that's on earned income. That 0.9% will hit. Also, the medical expense deduction AGI floor is going to increase. Currently, it's 7.5%. What that means is you can only deduct medical expenses that exceed 7.5% of your adjusted gross income. So you make $100,000, your adjusted gross income is $100,000, you can only deduct medical expenses that exceed $7,500. Next year, that's going up to 10%, so you will not be allowed to deduct anything unless it exceeds 10% of your adjusted gross income. So for that same taxpayer, you'd need to have another $2,500 in medical expenses in order to deduct $1 of medical expenses. So that's a big change. The alternative minimum tax, if they don't fix that, it will be the same as I discussed for this year. And next year, the marriage tax penalty returns with the expiration of the Bush tax cuts. And the marriage tax penalty basically is just that if you file a joint return, the standard deduction in the tax brackets are not double what if you filed a single return, what they would be. So married taxpayers actually hit the next tax bracket at lower levels of income than if they were single or if they filed single returns. So that is slated to come back. That was something that the Bush era tax cuts actually doubled the standard deduction and aligned the tax brackets, so it was actually double what a single taxpayer would pay. Some big changes too next year for depreciation. Section 179 expense deduction is going to be limited to $25,000, and that deduction is going to be reduced dollar for dollar for purchases that exceed $200,000. The requirements for Section 179 expense are the same that for this year, or next year as they are this year, valid for new and used assets and valid for the list of assets that I have here. Next year there will also be no bonus depreciation, so we went from 2011 where we had 100% bonus to 2012 where we had 50, and next year it will be 0 for bonus. State remains the same. 179 is limited to $25,000 and deductions reduced for purchases that exceed $200,000. So for the first time in many years, the federal and the state will match on that 179 deduction, and we don't have to add back won't have to add back anything when we do the state return. The state will also not allow bonus depreciation as Wisconsin has not for many years. One piece of good news, a credit that is going to start in 2013, I'm sorry. It was formerly known as the Qualified Production Activities Credit. I've included a fact sheet at the end of my materials here for this credit. It's based on the percentage of income that's derived from property assessed as manufacturing or agricultural property, and that property must be located in the state of Wisconsin. It's a credit that starts out at I think it's 8.75%, and by 2016 that credit is 7.5%. So if all your income comes from agricultural, from farming, by 2016 you could literally offset almost all of your income unless Wisconsin raises their income tax rate, but you could literally almost offset your entire income with this credit. Another good thing about the credit is if you can't take it in a year because the credit's more than your taxable income, you can carry it forward for 15 years. So this is good news for farmers. The next couple pages of slides, I just did a comparison from 2012 to 2013, and I've already talked about the first 4 bullet points on this page, and I just did this as a comparison. One thing I didn't talk about on the next page is that for the first time in several years, itemized deductions and personal exemptions are going to be phased out again. The last couple years we have not had a phase out for high income taxpayers of their itemized deductions or personal exemptions, but starting next year that's going to come into play again. So if you're a high income taxpayer, you're going to get socked with a couple extra taxes, you're going to be in a higher tax bracket, and you're going to lose some of your itemizations and personal exemptions. And you can see here there's a reduction of 3% of adjusted gross income for itemized deductions and 2% for each $2,500 of adjusted gross income in excess of the threshold amount. Now, the threshold amount has yet to be determined. I assume that if Obama is reelected, he will use the same threshold amount that he's using for the Medicare tax and the hospital insurance tax. And this $250,000 number has been thrown around a lot, so it's likely that it would be $200,000 if you're single taxpayer filing a single return, and $250,000 combined income if you're filing a married joint return. The last 3 bullet points on here I've already talked about. So we'll go on to the next page. Some tax planning. Tax planning obviously is difficult with the uncertainty with what's going to happen for next year. But what we can say is that it's probably likely the Bush tax cuts are going to expire, even if Obama isn't reelected. I think Mitt Romney has his own agenda for what in tax plan. So if the Bush tax cuts do expire, or even if they don't, this is what we know for this year, that if you have any stocks or mutual funds with unrealized gains, that you should maybe consider selling those to take advantage of the low capital gains rates, especially if you're in the 15% tax bracket, because you would pay nothing on those gains if you sell those this year. Same thing for assets, other assets, machinery and equipment. Take a look at selling those to take advantage of our low capital gains rates. If you sold anything on installment sale in this year, you may want to consider making an election to report the entire gain during 2012 instead of stretching that gain over the life of the installment sale. That can be done, but an election needs to be made for that. And C corporations can pay dividends, which will be taxed as capital gains rates instead of ordinary income rates. Some ideas for individuals. You can bundle itemized deductions by making extra mortgage payments, paying your real estate taxes on or before December 31st of this year, increasing your charitable contributions, or paying some medical bills. But the medical bills, you must be mindful that you have to have over 7.5% of your adjusted gross income, or you can't deduct any of those. Also, the American Opportunity Credit is set to expire at the end of this year. So if you're making any tuition payments, or you're going to be making tuition payments for next year, for 2013, you can consider paying those this year to take full advantage of that credit that is set to expire. Some additional tax planning for businesses, for farmers. You can prepay expenses, but you have to follow some requirements that the IRS sets. You must be a cash-based taxpayer. The prepayment must be for an actual purchase. It must not be for a deposit. And the prepayments must have a business purpose and not merely be for tax avoidance. Business purpose, locking in the price of inputs now is a good business purpose, and there are other business purposes, so that usually isn't an issue for taxpayers. You can also defer payments. The IRS does require that you have a deferred payment contract, and the contract should be in place before the grain or commodity is delivered to the buyer, and there should be something that says that the seller has no right to the proceeds until the following year, or you run into issues with the constructive receipt of income issue with the IRS. If you're current Richardson tax and accounting clients, and I recognize a lot of you, so I know you are, you can call us to set up a tax planning appointment if you haven't already come in to see us about that. If you're not, you can contact your tax practitioner if you have specific questions about your own tax situation, or you can call me with any general questions you have about tax planning. The final area I'm going to talk about is an area that, some areas where the IRS has been auditing taxpayers. The first one is the IRS is looking hard at Schedule E, and here Schedule E versus Schedule F. Schedule E is where we report rental income. Rental income reported on Schedule F is subject to self-employment tax. rent on Schedule E is not subject to self-employment tax. Determining where to report that depends on the rules for whether or not you're materially participating, and that's something we can look at with you if you have questions on that, and to make sure that you're reporting those on the correct schedules. The IRS is also scrutinizing S corporations. If you're an S corporation, you have to pay your shareholder employees and your corporate officers a reasonable compensation. The reason for this compensation is subject to employment taxes, whereas distributions from S corporations are not subject to employment taxes. So the IRS is looking at that to make sure that people are paying their employment taxes. I've listed in the third bullet point here some factors that the IRS uses to determine reasonable compensation, and you can take a look at those. A couple other areas, and these are areas that the IRS is actually focusing on taxpayers in the Midwest. One is like-kind exchanges. The IRS is looking for exchanges that don't qualify, so they're looking at transactions involving property that isn't like-kind, and they have very specific rules for what is like-kind. They're looking at transactions with related parties, and they're also looking to make sure that the taxpayers that are entering into these like-kind exchanges are reporting the basis amounts correctly, because a like-kind exchange, you can defer the tax, but ultimately we'll have to pay tax on that, and it all is driven, the gain on that is driven by the basis, so they're looking at the basis figures. The IRS is also focusing on taxpayers in the Midwest who fail to pay self-employment tax on their share of partnership income and or guaranteed payments. So if you're a partnership and have any questions on that, to make sure that's being done right, you can contact me or somebody at Richardson Tax and Accounting. We can take a look at that. And this slide was another slide I found on the internet. I thought it was kind of funny. And finally, my contact information. Once again, if you have any questions, concerns, you can contact me either by email or at one of the phone numbers listed on here, and I'd be happy to help you out.